Welcome to the Monocle Podcast. We are an independent management consulting firm, and in this podcast, we discuss our latest insights and opinions to help you achieve exceptional performance in banking and insurance together.
I'm Guy Walding, Monocle's research manager based in Johannesburg, and on today's episode, we're joined by Phoebe Maziba, one of our newest senior executives. Congratulations, Phoebe, on that, to chat to her about IFRS 17 cost allocation and how insurers should be using this as an opportunity to de-excel, and that's Microsoft Excel, their cost solutions by implementing automated cost allocation software. Phoebe, you're a chartered accountant and a qualified management accountant through CIMA, so we're excited to have you on the podcast, especially to speak about IFRS 17. So welcome.
Thank you, Guy. Glad to be here.
So before we start to talk about IFRS 17 and the accounting standards for insurers, can you give us a little bit of insight into why cost allocation is so important? So cost was never as interesting to talk about as profit, but it is very important for businesses, especially large financial ones, to consider.
That's a very interesting question, Guy. So cost allocation has become more of a focal point over the past years. The objective of cost allocation is to identify, classify, and assign expenditure for determination of the cost of products, projects, services, etc., also termed the cost object. So, Guy, cost objects are those items that you want to track the costs of individually. And if you want to track the cost of a project, which is a big project like an IFRS 17, or you want to track the cost object of a product, that's where cost allocation comes in and becomes important. So Monocle has been involved in various costing projects where the transparency and the tracking of costs is something that the clients really want to dig into. But Guy, also there's cost allocation is an entire discipline of its own, and I want to focus on 6 key points that we can talk through. So just starting from point 1 in terms of the importance of cost allocation, it assists in the decision making, understanding the direct and the indirect costs and how these can be managed to improve profitability or the quality of the services are part of the decision making process. Just an example of direct costs, that would be your salaries, and your indirect costs are the shared services functions like your HR and your IT. Number 2, determining the true profitability of a department or function. Knowing your costs and having them accurately allocated thus determines what is the true profitability. And that links to number 1 as well, which then will drive our decision making. Number 3, assist in determining the pricing based on the costing. This is particularly useful in large corporations in a group structure when needing to assert and transfer pricing when there is a transaction between subsidiaries. Number 4, as a recipient of costing in a group structure, having the accurate allocation of costs can actually impact the behavior. So it can drive the correct, efficient behavior, thus reducing waste. So you do better because you know better. Number 5, one of the important aspects of cost allocation is articulating the business value being delivered or received internally, especially for shared services, more specifically the IT function, where in a world of cloud computing, automation, AI, has the CIOs running their departments as a business, and it has changed the foundation of digital transformation. With that said, ITFM is a big topic at the moment, which is IT financial management. And that is part of allocating costs in the IT and what drives that and running the IT function as a business. So cost allocation is a big topic now in the IT function. Number 6, which we will elaborate on in our next topic, Guy, is just the impact on the reporting. Accurately allocating and categorizing our costs impacts the financial reporting directly.
So Phoebe, it sounds like businesses are going to receive more transparency and insights into how their business operates through cost allocation. Now, on our very first podcast, we had Celeste Matt also talking about IFRS 17, and she just stressed that insurers, they just cannot waste time when it comes down to compliance. The scope and the complexity is just too significant. And cost allocation is just one of those requirements. But how should insurers be allocating their costs under IFRS 17? And what are the benefits in comparison to what was previously around in IFRS 4?
Thank you for that question, Guy. So the difference between IFRS 4 and IFRS 17 is that IFRS 17 is more specific about the classification. And it's important to note that these inputs are used by the actuaries, so in their calculations, and ultimately in the CSM, which is the big IFRS 17 change as well. So with taking that into account, taking the fact that the classification of these expenses is also going to impact the face of our financials. And with that having a direct impact on the face of the financials, not only would I have an audit focus, but also a stakeholder focus. So what IFRS 17 paragraph B65 goes into is basically saying we have insurance acquisition cash flows, and these are cash flows arising from costs of selling, underwriting, and starting a group of insurance. We also have a policy administration and maintenance cost, such as costs of premium billing and handling policy changes. We also need to allocate fixed and variable overheads, such as cost of accounting, human resources, IT, and all of these need to be directly attributable to fulfilling an insurance contract. So anything that is not directly attributable to fulfilling an insurance contract, that needs to hit our income statement in the same year, and that needs to be recognized as other operating expenses. So with that said, we can have a decision tree, which is also something that insurers need to take into consideration, to saying what are our acquisition cash flows, what are our policy and maintenance costs, and what is it that's going to need to hit our income statement in the current year, because we can't classify them as either acquisition cash flow or administration and maintenance costs.
So, Phoebe, you mentioned about costs being expensed immediately or within the year. What kind of impact would that have on insurers now than what they'd previously been doing?
So, Guy, income less expenses give us our profit. And with these costs hitting the income statement in that year, that means that we're going to have less profit. So insurers need to be very careful what they classify as immediately expense or what needs to go through the income statement in the current year, because that will ultimately impact profit, the bottom line. And that is what our stakeholders look at. That impacts various ratios and the company's profitability as a whole. So the fact that it hits the income statement in the current year is going to increase our operating expenses compared to IFRS 4. Guys, it's also important to note that with there being a specific classification and paragraph with what cash flows are within the boundary of an insurance contract, it makes it more comparable, unlike IFRS 4, where entities were free to derive their own interpretations.
So at Monocle, we often see ourselves sitting between IT and business in order to kind of connect the technical standards that we see from finance and actuarial teams, those that they're concerned with, and connecting them to the practical kind of foundational IT and system architectures within insurers. Now, you've worked significantly with insurers to implement cost allocation software for IFRS 17. Can you tell us a bit more about your experiences and the solution implementation themselves?
Having an integrated and automated cost allocation platform has become a need now more than ever. It provides the foundation that improves overall cost allocation efficiency and ensures accuracy, transparency, auditability, and support for IFRS 17 readiness, Guy. As an execution partner, we as Monocle have assisted our client in implementing vendor software, as well as if they have an in-house built system. This assistance is throughout the cost lifecycle. So the data, the mapping, the configuration, right through to the transformation of the data, to the reporting, the visuals and the extracts, what the actuaries might need. We leave the client empowered to continue using the software as part of the post-implementation process in their BAU monthly processes. Our business knowledge, Guy, like you said, is our strong point. And in this case, it's IFRS 17. It's in the finance space where we took that together with our knowledge of various Microsoft tools and automation tools, together with knowing the vendor tool, and we assisted the client in making sure that their cost allocation process is seamless end to end.
Phoebe, we see a lot of financial institutions using Excel as the base for their solutions, and there's a reason for that. It's easy. Everyone knows how to use Excel. But why should insurers be avoiding Excel for their IFRS 17 cost allocation?
Even with the simplicity of Excel, its function and capability are inherently limited. The program has poor audit capability. It requires hundreds of workbooks to simultaneously be worked on, and we all know Excel has a tendency to crash when you least expect it to. Also, the granular detail and data quality required is only possible with a built-for-purpose tool, either developed in-house or provided by a third-party vendor. The end result of one of these powerful tools is far more thorough and accurate for the various stakeholders.
So, Phoebe, with any compliance project, there's a complexity, especially when working with insurers that have been around for far longer than the IFRS Foundation or the International Accounting Standard Board has. So there's a kind of a multitude of business and system development that's been established even before IFRS 17 or IFRS 4 came into being. So what are some of the pain points that come from implementing an automated solution for IFRS 17, and how has Monaco been able to assist our clients in overcoming these challenges?
IFRS 17 is a new standard and it's complex. So of course there'll be teething problems, and everyone is finding their feet around that. But some of the pain points that we've noted with being on the ground is just the granularity of the data and the accuracy that's received from the fellow BUs or subsidiaries when we have a group of companies. The data needs to be relevant, accurate, and complete. And with no stakeholder buy-in, or with one not being able to control the next BU, we're finding that to be a little bit of a pain point. So the data that's received is either delayed or is not of the relevant quality and standard that is needed for the tool. Also, solidifying the methodology and the drivers for the various cost allocation expenses has also been a little bit of the pain point, where ultimately you want to allocate your costs as accurately as possible. So coming up with a methodology, the drivers, and what are the volume, what's the source data that we are going to need is important, because what you could put in is what you get out. Just solidifying that based on the nature of the costs has also been a little bit of a pain point, but that's more needing the unpacking and the consultation, and that's where Monaco also comes in. Getting stakeholder buy-in as well. As we know, with anything new, you need a stakeholder buy-in. Change management. People are used to using Excel, and de-excelling, moving into a tool or a software is a complete change of mindset, and getting that stakeholder buy-in has proved not to be that easy.
So Phoebe, you spoke about the pain points and overcoming them, but what are some of the things that insurers will need to be focused on in order to effectively implement their cost solutions?
So Guy, the insurers need to focus on what it is that they want from the cost allocation model. With it being automated, optimized, it will focus on IFRS 17, but also on a daily basis. What do they want from it? What are the visuals? What are the reports they want? How do they want it to change their BAU for the tool to work for them? Because when you get a vendor tool or you build a system, you want it to work for you as effectively and efficiently as possible. Also, the focus needs to be on how granular is granular. And that's where the detail assessment needs to happen of all our expenses, all our cost centers. How are we classifying them according to IFRS 17? So auditor involvement at this point becomes very important. Do we have everything we need at the level we need it at? That is the focal point. Guy, another focal point is the data. Where is the data sourced? Insurers need to focus on making sure that the data that will be sourced is accurate, clean, and complete, and it is available.
I mean, that's a lot of requirements just around cost allocation. But we also know that IFRS 17 is more than just cost allocation. So with the 2023 deadline approaching, what are some of the other requirements that insurers need to be aware of and be prioritizing?
Definitely the change in and disclosures. So mapping out how the move from IFRS 4 to IFRS 17 is going to impact the face of our financial statements. Another thing is just looking at our comparatives. How's that going to impact our financial results? Making sure that when 2023 comes closer, we know the overall impact from not only from financials perspective, but also from an operational perspective. So being able to do the testing and parallel runs, that it's just an easier switch and rather take the pain now. And you've had some of those discussions with Celeste where insurers need to be ready and have projects that are focused on IFRS 17.
So thanks, Phoebe, for coming onto the podcast and for sharing your insights on a really relevant topic that is only going to become more of a priority in the future.
It's my pleasure, Guy.
So for our listeners who'd like to learn more about what we do at Monocle and how we support our clients with their cost allocation engagements, you can find our IFRS 17 cost allocation brochure linked below. You can also visit our website to understand our core capabilities and view our full range of insights and Monocle podcasts. Similarly, if you'd like to contact us, you can find all our details on the website for both our European and South African practices. Phoebe, thanks again for coming on, and to our listeners, thank you for listening.
Visit monocle.co.za or co.uk to subscribe for updates. From Johannesburg to London, Cape Town to Amsterdam, Monocle, we design change.